Hi, it's Brad Simmons from Ocean Consulting Services. In today's video, we'll be discussing payroll tax debt. Am I really responsible for company debt? So let's run down some highlights. Normally, business entities provide owners and employees with legal protection from company liabilities. However, there are certain tax debts, payroll tax debts, that can be collected from individuals. There's potential liability for not only the business owner, but also individuals who are associated with the business. We'll be discussing sort of the mechanics of payroll taxes and how individuals other than the business can be potentially held responsible for the debts of the business. So let me give a quick overview of what payroll taxes are. It's relating to compensation paid to employees. So these are not payments to independent contractors. They're wage payments that are made to employees of the business. There's two types of payroll taxes, the employee portion and the employer portion. The employee portion is relating to tax withholding and also payment of FICA tax. So this is the FICA tax burden that's imposed on the individual. The employer portion of the tax relates to the FICA matching. So whatever the employee pays, the company is required to match that payment. The employee portion is referred to as a trust fund tax. The employer is really holding the employee funds that are required to be paid to the IRS. Quick way to think about it is if I owed you $100 in wages, and I was required to withhold and pay over to the government $20, those are the trust fund taxes. It's really a component of your wage that I, as the employer, are withholding and required to remit to the government. So the government really views this as employee funds, not just a tax liability owed by the company. And again, contrasting that with the employer portion of the tax, which is a company level tax. So now let's talk about the legal liability for the tax. The business is responsible for the entire underpayment, whether it's employee tax withholding, employee FICA withholding, or the employer portion of the tax, and obviously any interest or penalties. That's all completely an obligation of the employer. And the IRS will use their normal collection techniques against the business to enforce collection. The IRS can also pursue collection against certain individuals for the trust fund taxes, for the employee portion of the payroll tax. The rules state that any person who is, in quotes, required to collect, truthfully account for, and pay over any tax imposed, and who willfully fails to collect such tax or truthfully account for and pay over such tax. So you'll notice in that language, nowhere does it say the liability is limited to a business entity or to the owners of that business. Let's talk about what is referred to as a trust fund tax penalty. The tax law imposes what I'll put in quotes, penalty relating to the employee portion of the payroll taxes, so relating to the trust fund taxes. The amount of this penalty is 100% of the unpaid tax. The IRS can pursue collection against both the business and individual or individuals. The concept is similar to what happens when a married couple files a joint tax return. The IRS can pursue collection of the tax against multiple parties. The IRS can attempt to collect 100% of the tax from both the business and the individual or individuals. Now, of course, they can't collect more than the total, but they can pursue collection of 100% of the trust fund tax against both the company and the individuals. So what's involved with the process? The IRS first has to make the determination that an individual or individuals are responsible for the trust fund tax penalty. That usually includes the business owner in many, if not all cases, but also could include individuals who have payroll responsibility. So that could be the CFO, could be a general manager, could be a bookkeeper. The potential liability isn't limited to someone's job description or ownership interest in the business. It's really relating to what I referred to before as responsibility for collecting and paying over the withholding taxes. The IRS can pursue collection of the trust fund tax penalty just as if it were any other tax. They issue notices, they can issue a lien, they can levy against periodic income, they can seize assets, etc. And this also means that there are collection alternatives available if the tax is ultimately owed by an individual. Those would include installment agreements, offers in compromise, etc. Now, who is a responsible person and who makes that determination? Well, as I mentioned, the IRS makes that determination. They use what's referred to as a Form 4180. And if you read the form, it's really just a series of yes/no questions. There's really not a lot of opportunity to provide explanation. Given that, we usually recommend that our clients do not sit with an IRS agent to complete the form. What we recommend is that we assist our clients in the preparation of the form, answer the questions truthfully, and provide context. So we provide attached statements that describe an individual's responsibility and job duties, because those are typically not captured in the strict yes/no format of the questionnaire. One other thing to note, this is usually a civil matter. However, it could turn into a criminal matter, and situations where we see this happen is where an owner willfully doesn't pay over withholding taxes, distributes that money to him or herself, and funds an extravagant lifestyle. Just something to watch out for. Normally civil, but the case could be turned into a criminal matter. We'll wrap up here. The IRS does view this non-payment of the employee portion, so the trust fund tax, as a serious matter. The employer is viewed as holding the funds on behalf of its employees. So these are really wages that should have gone to an employee, but instead were required to be turned over to the government. This is viewed as a more serious matter than the underpayment of income or other company-imposed taxes. Think before you speak. The situations where we most often see issues arise is where an individual sits with an IRS agent, goes through the Form 4810, answers yes and no. The IRS makes a determination that that person is a responsible person. If the individual had been allowed to provide additional information, they may not be deemed a responsible person. That's it for today. Up next, we'll be discussing IRS appeals process. Thanks for joining us, and as always, feel free to contact us if you need any assistance.